Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us, Nancy Lazar, Chief Global Economist, Piper Sandler. You killed it in July about we can't get private enterprise to employ people. Has the song changed in the last 6 months?
Near term, no. Employment's going to be on the weak side. Companies are still really focused on their profit margins, but employment's a lagging indicator, quite frankly. The government did crowd out employment earlier over the past couple of years. The healthcare industry crowded out the private sector, education. And so we're kind of unwinding that right now.
Right.
So that's also a headwind, along with the private sector still a little bit focused on protecting their profit margins.
When do we get back to job formation that doesn't involve healthcare workers and bartenders?
Probably in mid-2020, mid-2026. You're seeing green shoots for the labor markets. You have profits improving across the board, both S&P 500, S&P 600, Russell 2000. So you're getting the breadth of now profits. Companies are willing to spend. They always first spend on technology to further improve their productivity and their profitability. And then you get employment. Employment is a lagging indicator. So you're setting the stage for employment as you move into the second, third quarter of 2026. And you are getting some indications that it is incrementally improving. Small businesses have stopped firing, which is, again, the first step in getting job hiring as we go through 2026.
We've got a little bit of hindsight here, Nancy, with tariffs. What happened with tariffs? How did they kind of impact the economy? How are they impacting the economy?
Yeah. So first, they are a tax. Tariffs are a tax. How much, as a share of GDP, you're about over 10% as a hit, up from 2% at the beginning of the year. And it's really a regressive tax on that lower end consumer, on smaller businesses. There have been some offsets where some durable good prices have gone up, other service prices have gone down, some food prices have gone down, but net, they have kept inflation. They have kept inflation sticky this year.
Going forward here, I mean, I'm looking at some of the early retail sales we got from Black Friday, Cyber Monday, whatever it's called, and so on. Seems like the consumer is still okay out there. How do you view the consumer?
So a consumer out of a slump, consumer spending always turns up. I went back and looked at all cycles since 1960. Consumer spending always turns up before jobs turn up. Okay. Why? They're highly cyclical. Interest rates are down. Banks are willing to make loans. They're refinancing their credit card debt. They're using HELOC, going from something over 20% to something less than 10%. So it's not jobs that actually drive consumer spending. It's the Fed. And then as you go into 2026, we're going to get a big booster shot to disposable income from these tax refunds.
Nancy Lazar with us, folks, across the nation. We welcome all of you finishing out the year. Are we drowning in outlooks? Sam Rowe has like 47 outlooks to read just today.
It's okay.
He's in charge of reading outlooks. We listen to Sam Rowe, R.O. Look for him on Substack as well. But with Nancy Lazar, we have someone steeped in the linkage here of a nation's history into our economy. I look at Ken Burns' Magisterial American Revolution. There's a little bit of grievance there, which they highlight, versus just simply, Philadelphia against the king. It's a little more complicated than that. The Edelman Trust Barometer this year, the high level of grievance towards government, business, and the rich. And it's this daily grievance and agony within the news media. You fought that for decades.
Yeah.
Is it morning in America and we just don't know it?
Oh, I think that's been unfolding for 15 years. We've called it the U.S. manufacturing renaissance. Started back in 2010. Middle America is our favorite emerging market. You're seeing it certainly within unemployment rates around individual states that are more business friendly. So, and current policies certainly are going to reinforce bringing back blue collar jobs to the United States. And so we're quite excited. At first, the private sector started back in 2010. The corporate tax cut in 2017 reinforced it. And now full capex depreciation is another major booster shot for the kind of reindustrialization of the United States, which is a necessary backbone for every economy. I worry about Germany, Europe in general, by allowing China to come in and dump cars. You need a diverse source of jobs because we have a diverse labor force, and we need a big. Consumers need to have a choice of what kind of job. Not everyone wants to go to college. Nothing wrong with blue collar jobs. Nothing wrong with getting
Nothing wrong with blue collar jobs, Paul. Mrs. Keene insists we're hanging wallpaper. Have you priced out wallpaper hangers?
Oh yeah, absolutely.
So, I mean, there's physicians at Mount Sinai that aren't making that kind of
stuff. So, I mean, give us a sense of kind of the labor market here, because it seems solid. The unemployment rate, the headline number that we all look at, seems fine. Seems kind of full employment-ish. Is it as strong as it looks?
Well, under the hood, you have had some significant layoff announcements here in the fourth quarter, and so there is a chance that the unemployment rate does grind higher as we go into the first part of 2026, maybe around 5%. Some of the leading indicators point to about 5%, but that's historically, as you just said, still not high. And the labor market is a lagging indicator, and as we go through 26, I think it is incrementally going to start to heal.
Tell me about it. I'm looking. Paul taught me this screen, the WEI screens. S&P up 16% year to date. Nasdaq, full Nasdaq, up 21% year to date. I'm going to suggest, Nancy, that's on the back of a sprightly nominal GDP. I see all sorts of opinions on government shutdown. I get that, but do you just assume we can sustain 4% plus nominal GDP and at least okay real GDP?
Oh, I think, to be sure, policy is very supportive of growth, and our corporate backbone is very, very healthy from a productivity perspective. So combination of the Fed cutting rates 150 basis points over the past over a year now, banks easing lending standards, very productive fiscal policy, not government spending, but tax incentives for the private sector to invest, tax refunds for the consumer. I think 4% is actually probably on the low side. Could be stronger than that.
Corporate earnings, they seem to be pretty good. I mean, the third quarter numbers, low double digits. Second quarter was strong.
And now it's off a cliff. Oh, it's terrible.
Exactly.
We have no idea where we'll be in January.
Exactly.
No. What's happened with the corporate profit backdrop, it's definitely broadening out, which is what we needed. It was led by, the Mag 7 or 8 or 9 or whatever. Now it's into the smaller cap space, which is crucial because that's where the jobs are created. And so again, with that healing in small cap earnings, you are setting the stage for a healthier labor market as you go into 26.
The way we roll this morning at the 9 o'clock hour, Michael Green will be with us. His Substack on the poverty line created a firestorm across the nation. Michael Green will join us for first extended comments on this. And we start here with Nancy Lazar of Piper Sandler as well. Michael Green says the poverty line, it's constructed, it's a formula and all that, but there's a lot of Americans struggling at a higher income level than the poverty line. Do you buy it?
I'm not that schooled on his analysis. I think that's probably a little bit of an exaggeration. I grew up in Middle America. The cost of living there is a lot lower than it is in the East Coast or
right. He based it on, Paul, help me, Caldwell, New Jersey.
Yeah, sure. Yep.
I would agree that the low-end consumer has been squeezed. I think that's going to change as we go into...
How is it going to change?
That you are going to see a broader and broader footprint of industries hiring, making it possible for people with many different skills actually to get a job.
She's too optimistic to be on the show, Paul. Do something.
Exactly. Given that backdrop, Nancy, I guess we're going to hear from our Fed next week, a week from today. Presumably the market's discounting a rate cut. How aggressive does the Fed need to be in cutting rates, do you think?
I don't think they need to be aggressive. They probably will continue to cut, given the sluggishness in the labor market. They classically, even when the economy picks up, again, I went back and looked at all cycles, even when the economy picks up, the Fed tends to continue to cut rates because they are focused on the labor market, and the labor market is a lagging indicator. I'd be careful in cutting too aggressively because they've already cut 150 basis points, and you have this fiscal support.
Years ago, it was Hyman Lazar. Everybody thought Hyman could be chairman. Everybody thought Lazar could be chairman. Let's take that perspective. If you look at Nancy Lazar now, is there a threat to Fed independence?
I don't think so. I think the bond vigilante is going to make sure of that. We saw the bond
Chairman Hassett's going to be told what to do by the bond market.
I think so. I think last year it's something that happened often in the 60s and 70s. It happened last fall when the Fed cut too aggressively, when inflation was still too sticky. So yes, I think the bond market will be that vigilante.
So what's the opportunity here for, we're talking about a lot of this reshoring and the growth of manufacturing in the U.S. Is that going to fundamentally change our economy in any way, shape, or form?
Big time. I
mean,
mean,
how is that?
It's, again, you need labor force participation to continue to increase. And the only way you do that is through offering a broader footprint of industries hiring. With this onshoring, you also have a huge job multiplier. It's not just people complain to me, well, not many people work in factories today. It's like, I know that. I grew up in that environment. It's changed dramatically over the decades. At the end of the day, though, it's the multiplier supporting these factories, smaller businesses, restaurants, grocery stores.
Right. The industry, we're guilty of this. Lisa's the only one who's not. We're based on 3 zip codes in Manhattan.
Yeah.
Lisa has a much broader perspective than that. Piper will always and forever be the great Northwest. It will be Minneapolis as well. What do the fancy people in New York City and Washington not get about business formation north of the Mayo Clinic?
That you do need. I'm being very redundant here, and I apologize.
No, we like that. It's retired. Okay.
It's that you do need a diverse set of jobs. You don't need to go to college. I was tickled. Palantir announced that they are hiring a bunch of high school kids to check out the work ethic. And do you want to go to college or do you want to stay?
Does AI help the kids that go, I just don't want to take Shakespearean 102? Does AI help those kids?
Technological innovation has always made education better, from using my Bomar brain to eventually going to Excel, etc. So absolutely, technological innovation is great for kids as long as it's properly used.
Yep. So going forward here, I'm thinking about kind of where we need to go here. I mean, it seems like this economy is in pretty good shape. Is that your consensus? I mean, I know there's some crosswinds and headwinds out there, but I mean, I'm seeing growth out there. I'm seeing interest rates coming down. I'm seeing corporate profits pretty darn steady. It seems like it's a pretty solid position.
I've been listening to people talk about the dollar and how the dollar is going to go down, and I just tend to disagree with that. I mean, I think Europe growth will be okay in 2020, in 2026 because of the stimulus that they've put in place, both monetary and fiscal. But if we can get to 1.5%, that's good news.
We got you here. We got a breaking headline. This was made for Nancy Lazar. Automatic data processing. Nobody knows. That's like Minnesota mining and manufacturing.
That's right.
Automatic data processing, U.S. November. Private employment falls 32,000. The estimate was plus 10,000.
Yeah.
What happens emotionally when we go over 4.5% unemployment rate? Is that critical, or do I need to get to 5.0?
I think 5% is where I think I gave you earlier that something with a 4 handle is still pretty on the tame side, but we do think you could move above 5 as you go into early 2026. But that is a lagging indicator. It's not going to change our outlook where we think growth is going to reaccelerate. We're 2% GDP growth this year with all the headwinds that we've had, the shutdown, the tariffs. Next year it's going to be stronger than that, given all the stimulus.
As I said in my intro, like I don't remember who was on the show 2 hours ago. Lisa has to remind me. I certainly don't remember who was on the show 3 days ago. I remember crystal clear with the sun coming through in July when Nancy Lazar talked to us about the American labor economy.
Yeah, absolutely.
Truly, Nancy, one of the great insights of Bloomberg surveillance this year. She is with Piper Sandler. Stay with us. More from Bloomberg surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Joining us now, Michael Green Pinata of Simplify Asset Management. How the hell are you?
I definitely have taken a few whacks with the baseball at this point.
I'm going to defend you, okay? I get it. There's people. Michael Green's an idiot. How dare he think 140,000 is a poverty line? You say up front, it's where you live. And you go, and Paul, you know this better than me. You go to Caldwell, New Jersey, near Cedar Grove, just south of Little Falls Township, and say, I'm sorry, the poverty line in Caldwell, New Jersey is not the way it is 80 miles south of Louisville. Discuss.
Yeah, this really is the underlying story. First, there are multiple poverty lines, right? Across the country, if you live in a high-cost region, you're going to have a very different experience than if you live in a low-cost region. But the overall point was, when you start thinking about what we define as the poverty line currently, at about $31,200 for a family of 4, 2 earners, 2 children, that doesn't come anywhere close to meeting the needs of a family that is living in a place like Caldwell, New Jersey, where the calculation works out to about $136,500 needs to be made before you can even start saving a dime.
Wow.
Right? That's an extraordinary feeling of precarity when we talk about the dynamic that most American households can't afford something to break, can't afford an emergency expense, et cetera. That's why.
So who sets the poverty line? Again, it's around 32,000 nationally in the U.S. Who sets that poverty line, and how does that impact policies and support group levels and policies?
Yeah, I think this is one of the really critical things that keeps coming out, right? Many people will point out that poverty lines are arbitrary, right? We can define 20% of the population as poor, et cetera. It really doesn't matter where it is unless it affects policy. And that number, which is maintained by the Department of Health and Human Services, is updated by the CPI from the BLS, is used to define the point at which we begin withdrawing benefits from many types of activities, things like housing, things like healthcare, things like food support. That creates a valley that I call the valley of death, but more accurately is described as the benefit cliff. Once you start passing those thresholds of earnings, the government starts taking away the benefits, and it actually leaves you in a position where between about $40,000 and $100,000, largely on a nationwide basis, you find yourself with marginal tax rates that can exceed 100% in some situations.
So what are some of the areas where maybe the government numbers aren't correctly calculating the true cost of what it means to live in it? Is it housing? Is it childcare? Is it healthcare?
The crazy part is it's all of those things, right? So the simple reality is that the CPI is devised by the BLS. You are not going to find me in here arguing conspiracy in an attempt to suppress it, et cetera. But it's used to define certain types of price changes. The CPI that we quote for policy purposes is the CPI urban wage earners. This is what you would expect to experience if you are buying a representative basket across all of the workers in the United States, high income, low income, et cetera. People who are at the poverty line or near the poverty line don't have the same choices that you and I have when they make purchases. They don't get to decide, hey, I'm going to wait until tires go on sale, right? Nor are they benefiting from, gosh, the air conditioner that I had 30 years ago suddenly costs a lot less or works much more efficiently. In most situations, they aren't even evaluating, do I buy an air conditioner? And so a really simple example of this is in housing, we incorporate features like air conditioning through a quality metric, a hedonic adjustment, right, that basically says, look, I understand that the apartment went from $1,000 to $1,100, but because they installed air conditioning for you, right, it's really only $1,000. You actually had
or granite slabs in the kitchen as well. Part 1, My Life is a Lie, How a Broken Benchmark Quietly Broke America, a Substack which lit on fire across Thinking America. Michael Green, with this was Simplify Asset. We'll get to his view on the View forward to 26, but this is too important a discussion. My basic take off your good work, the critics of your work, the supporters of your work, is the poor get to a point, as you stated moments ago, where things are taken away from them and they have almost a disincentive to work. We talked to Huw van Steenis. This sounds like United Kingdom 101. What does a Mayor Mamdani do? What does the next president, Republican or Democrat, do to incentivize people besides taking government programs away?
Well, in the most extreme version of this, right, they are actually solving for what people are saying, which is, I'm not being listened to. So when Mamdani addresses affordability and says people are struggling, they recognize that he's telling the truth. His solutions would not be my solutions. And that's part of my frustration with the rights perspective or the conservative component of this. If we're putting people in a position in which they're forced to turn to somebody who is listening to them and offering bad solutions, we can sit there, and be uptight and basically say, well, they're choosing socialism. We'll show them, right? They're going to have the worst possible outcome. Or we can recognize that we're facing conditions that look an awful lot like the French Revolution, in which we're basically saying, well, they can always eat cake. right? That's absurd. That's not what we want to do. We need to actually engage the national discussion before we hit rock bottom so we can make the relatively easy and painless choices to reform the system, improve the outcomes, improve the incentives, and I'm sorry, reverse those, improve the incentives and then improve the outcomes so that people are able to make the choices that allow them to pursue happiness.
Like the poverty, I'm learning so much about this, and I didn't even think about it, quite frankly, but the poverty line was created by the Social Security Administration in 1963, adopted next year by the White House. And the person who created it set the threshold at 3 times the minimum adequate food budget.
Yeah.
Right, that makes sense. It seems simple, but it kind of makes sense. But the world's changed since then, and so that is not a good predictor anymore?
Yeah, it's radically changed. So, I mean, the reason that the 3 times was chosen was not because of the 32% or the 33%, but because that was a way of scaling up and capturing the entire budget.
Okay.
Right?
Yeah.
So they were basically saying, look, if you're spending a third on food, you're likely spending a third on housing, and you're likely spending a third on the other necessities of life, telephone, transportation, et cetera. Unfortunately, what has happened is we froze that. And as I described before, CPI doesn't meaningfully capture the underlying cash increase that's actually happening. And so really what that line has moved to the point of which it is just basically describing starvation, right? It's not, it doesn't actually mean anything anymore.
Michael Green with us here. We do have breaking news, and the markets have moved on it. This is a small startup company named Microsoft. Microsoft lowers AI software sales quotas. Stock down 2%. The market was up, futures up 20, and markets were up 20, and S&P down minus 19 as well. That sources the information. We thank them for that. Microsoft lowers AI software sales quotas, and it moves the market. Let's say a little bit more on this, Michael Green, and then we've got to look to simplify asset management in the view for 2026. Do you parse a distinction between Republican and Democrat solutions to half of America flat on their back?
You know, the challenge is I don't think either party is actually coming up with good solutions. Instead, they both appear to be in pursuit of power to basically prosecute their individual agendas. I would really love to say that there is a meaningful distinguishing characteristic. Largely on the right is we should cut benefits further. And on the left is we should expand them willy-nilly, right? That's part of the reason for the vitriol is that both sides effectively see this as either stealing ammunition from a focus on the poor, or on the right, basically creating the ammunition that could be used to meaningfully expand benefits in a culture of dependency.
We go to surveillance childcare correspondent Lisa Mateo. The last echo I heard through the kitchen was empty the dishwasher as well. Lisa, the heart of this, within the list of Michael Green within his Substack, what I hear from people, I don't care what they're making, childcare out of COVID, there's no other issue.
Oh, sure. No, most definitely. I mean, a lot of people I know, moms are staying home because of it, to take care of the kids because they can't afford the childcare. They think it's better for them to be able to just stay home and take care of the kids, and that would be the salary. Like, it's kind of like.
And I'm surprised of all the benefit packages out there that companies, corporate America, offer their employees. Whether it's healthcare or wellness or all this other, there isn't a childcare offering. I don't see that talked about enough.
Other countries.
Yes. Well, Matt Miller came back from Germany to come back here to Bloomberg in New York. That was the first thing that jumped out at him.
No, the first thing he did was buy Bitcoin at like $5,000.
And then lost his token.
Michael Green with us here, and we're going to move on. But are you going to write a sequel to this Substack? I mean, are we publishing today? Can we make an announcement?
I'll get the movie rights.
I'm trying to write this as a weekly series. The third part with some proposed solutions comes out this week. And at that point, I'm sure I will piss everybody off to the extent that nobody wants to hear my name again.
Michael Green, My Life is a Lie, Part 1. There it is, the Substack. Oh, it's only $800 a year for, I'm kidding. It's extremely reasonable. Accessibility, some of the best minds out there. Paul Krugman's out there, Adam Tooze, Michael Green as well. What is the Simplify Asset view to 2026?
Look, we are always somewhat cautious. Most of our portfolio is focused around fixed income. We recognize that the growing need for most households is income, and that tends to represent the focus in our portfolio. I'm very concerned about the rising risks in the credit space. In particular, you highlighted a downgrade in Microsoft's AI expenditures. An incredible amount of capital investment is being driven off of the AI framework that's bleeding into the credit markets. We're seeing this with things like the deteriorating loan credit for companies like Blue Owl, et cetera. I'm concerned, and I've written about this, that unfortunately in a world that's dominated by passive investing, the market is largely responding to flows that are coming in from people who are employed. That means that the market is increasingly associated with a lagging indicator. And if employment continues to weaken, as we saw with today's ADP, I would expect that ultimately begins to put pressure on the market.
And the Fed cutting rates, how impactful is that, do you think?
Well, I think it can actually be somewhat impactful. And the reason why, though, is a bit confusing. If you think about portfolios like target date funds or systematically rebalancing portfolios, if the Fed cuts rates, that causes bonds to rise in price. The way we're supposed to think about it is the lower interest rate is run on a discounted cash flow analysis and gives a marginally higher value for equities. But if I have a systematically rebalanced portfolio and my 50% weight in bonds goes up 2%, well, now I'm underweight equities and I have to buy equities, sell some bonds. I think that defines the behavior that we've seen far more than anyone doing fundamental analysis at this point.
That was beautifully described. Summarize again this. The bond market, folks, drives the marginal equity purchase or sale. Was that
and the reverse, yeah. That's the 3x5, right? The two assets in a systematically rebalanced portfolio are tied by their price behavior.
I think I get that.
Yeah, it's Michael Green 101.
Yeah, exactly.
How are the hedge funds doing? I mean, everybody's trying to bet the market. Everybody's trying to arbitrage and get an edge. Did financial Wall Street get an edge this year?
Well, I think it depends on how you define it, right? So many hedge funds are doing extraordinarily well, particularly those that are focused in areas that are components of arbitrage. We've seen an incredible growth of things like the Treasury basis trade, which is very, very similar in its underlying construction to equity index arbitrage, where you're speculating on what's going to be in the index, what's not in the index, et cetera. Those have been very fruitful areas for investment. I think the macro calls have been a lot harder this year, right? People have struggled with the direction of interest rates. At the start of the year, we were losing control. I was skeptical of that. It ended up being right. But the simple reality is we've had lots of movement in both directions with no real clear outcome yet.
I got to get your Substack going. Are you going to write on Bitcoin?
I have written on Bitcoin. I actually want to emphasize that Substack is both cheap. It is subsidized for those who buy simplified products. And candidly, if you send me a message over Substack or Twitter and say I simply can't afford it, I'm more than happy to grant.
I sent you that email.
Tom, you are fully subscribed.
Oh, you think that's funny over there, Miss Mateo?
There you go. It's good stuff.
That ultimately puts us into a situation where there's lots of stuff that's out there on the Substack. I encourage people to read it, and I also encourage you to find better ways to spend your time.
Yeah, I'm thinking about who did he upset the most? Bernie Sanders or Lindsey Graham?
I don't know. I have no. It could go either way.
If I got them both mad, then I probably did the right thing.
Then you're doing your job right.
You changed the debate. Cover the Washington Post. Michael Green, Simplify Asset Management. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Huw van Steenis, a magical moment a couple weeks ago with Dan Tannenbaum, with Oliver Wyman. Mr. van Steenis has all sorts of perspective on banking, but also on his United Kingdom. He has served the nation at Treasury and also with Mr. Carney at Bank of England. Huw joins us this morning. Huw, end of the year here, I want to take a step back, and I think everyone listening in America in this morning goes, what's it going to take for Britain to recover? The Prime Minister going after Brexit, I believe, yesterday and such. What is this van Steenis pixie dust to get Britain to turn it around?
Well, Tom, thanks for having me back on. Look, I think it's a great question. I mean, I think one thing we debated before is that since Brexit, the UK's become ever more European. And in fact, as of last week, we have the same tax rates as France. But with none of the benefits of being in the EU from a trading bloc. And maybe, some of the animal spirits that we so loved about the UK being a bit dampened. So look, the thesis for me would be how we can get back to be more mid-Atlantic. And now I think there are some positives here. I think about it, we've got amazing entrepreneurs, amazing companies. In fact, we've got 3 of the top universities in the world, and the clusters of development around them are really exciting. But we need to be mid-Atlantic. And so if you want to have one positive, this week, the Bank of England announced it's moving in the direction of the Fed and the Trump's policy, which is bank regulation is going to be refined. And actually, this is probably the first mid-Atlantic step we've taken in the last decade. So amidst the doom and gloom about the taxes, there are some positives, at least financial regulations heading in the right direction.
And it appears McLaren reigns ascendant in Abu Dhabi this weekend with Lando and Piastri getting it done maybe against Vince. It's just like the 16th century or something.
Sure.
I mean, it's not... Huw, what's the city look like? Paul and I want to know if we visit, like what's the vibrancy of the city versus the boom in New York?
Well, look, please come over and visit. Look, your offices in London are still in a fantastic place, and London is busy. But no, look, as I'm in New York, every 6 weeks, it's New York's booming, London's rolling over, and there is clearly some amazing entrepreneurs, but it's just not got the same buzz as New York, where there's excitement. But that said, as I meet with the private market firms, they're very excited about the outlook for M&A in the UK next year. We've seen 2 US private market firms acquire insurers this year because they're excited by the financial deregulation allowing them to invest. So, around the edges, there's still an awful lot of excitement, but the streets don't have the buzz of New York, of course.
Talk to us about private credit here. Huw, this is obviously a significant new market over the last 10 to 15 years. There's been some concerns about credit quality creeping into this part of the market. How do you see it? Because you've got so much experience looking at the financial markets.
Look, Paul, I think the thing which is misunderstood is that we've now got an asset class or a range of assets which are almost 3 trillion in size. And there's going to be the good, the bad, and the ugly in that area. And so if I sort of break it into, let's say, there's mid-market finance, there's acquisition finance, and there's obviously all this investment grade private. And I think it's very different rhythms in the market. So in leveraged finance, of course, there are companies who borrowed before interest rates went up, probably have the wrong capital structure, and maybe if they haven't had the cash flow to work through the debt, we'll need to restructure. And that's the area of real focus and tension where you're seeing, the percentage of PIK being paid, payment in kind instead of cash interest has been picking up. And there's clearly going to be some restructurings, or highly likely to be some restructurings in that area. We flip to the other side. The biggest boomers we've discussed before has been insurers giving money to private credit to get about a 1 to 1.5% pickup on what they could in the public markets. Those loans are much more around infrastructure, data centers, utilities. Now, I'm not saying that there couldn't be some credit events there, but that's a very different part of the economy, which is booming, has huge capital needs. And because, as you see with the data center issuance, they're having to tap the private markets as well as public markets because the need for CapEx is so overwhelming. So I think we've got different rhythms. I think there are going to be some credit events, but I think in a way where we need to think about this is credit overall. This is a very diversified marketplace, and there's going to be some things are hot and some things which, quite frankly, will fail.
So, Huw, where for 2026, what are the key themes you're looking at here? Because you could step back and say, boy, generally the economies are generally pretty strong. Inflation's there, but it's not too much of a risk. We've got most central banks cutting rates. For a lot of folks, and corporate earnings seem pretty solid from a lot of folks, that seems pretty constructive for risk assets. Is that your view, or are you a little bit different?
No, look, I can, the areas of the market that I know well, let's say take European banks, I'm pretty constructive still. I don't see a big pickup in bad debts. I see the interest rate environment being conducive, but there's not much growth here. But I think in terms of the themes, look, I've got 3 big themes for next year. So one is mercantilism. How will the tariff policies, that invest domestically, how will mercantilism not just play out in the US and China, but what happens to Europe being the piggy in the middle? Do they really invest and take advantage?
Right.
Someone like Norway with all its rare earths, or will they get panicked and make some poor deals. So I think mercantilism and how that plays out, I think is really key. I think second is the whole AI data boom, the whole CapEx. Does that continue to have real force? Because in which case, that's very positive backdrop for at least banks and financial markets, because there's a huge need for credit. And then the third is like kind of, we've had is then the debate about the cycle in Europe, and really will we take advantage? Is this late cycle and we're going to go into a slight slowdown, or will Europe start to get its sort of mojo back together again? So they're for me the three big themes for 2026.
The acclaim started with European banking and penetrating analysis of income statements. Huw van Steenis, with that background, your thoughts on how private credit will clear given lower valuations than expected. How is that process going to play out?
So, Tom, I think this goes back to this multi-speed. So I think that, in the CapEx-rich, insurance-supported, quite frankly, boom around CapEx, I think that the demand for capital is so high, it's actually providing a bit of a risk premium, and that's why you're still seeing this extra. So I think that piece of the market, absent a major shock, is in really good shape. But I think around acquisition finance, those deals which were written, 5-6 years ago, probably over-levered in terms of companies. If they haven't had that cash flow work through, then I suspect there will be some. There are clearly going to be some restructurings and credit events. I think what you've seen, Tom, is that if you like, the continuation funds, the secondary funds, the PIC, the innovations that the credit markets have been trying to help private equity owners through a cycle where they haven't been able to sell. And so the bull case is that the pickup in M&A that you've had on the show, whether it's Morgan Stanley, JP Morgan, Goldman's, are expecting, if that M&A and IPO boom picks up, that's a release valve. Right. But if that doesn't play out, then I still think we're going to get, a couple of percent restructurings next year of that cohort, which, are under a lot of pressure. Right.
Huw, take that phone call. It's Tottenham. They're looking for a new coach. I know they are. Huw van Steenis, the next coach of the Tots, with us. He is with Oliver Wyman there on his disunited kingdom. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The newspaper, she's been working at it diligently since 4:22 this morning. Lisa Mateo.
You got it. Let's start with this. San Francisco drivers are saying that Waymo self-driving cars are behaving like New York City taxi drivers.
Oh, boy.
They're getting aggressive, okay? Wall Street Journal spoke to some of them.
Ooh, this is a big issue.
Have you seen it? Okay. So they're saying they're in the tunnel and they're changing lanes, by the San Francisco area. They're making illegal U-turns. And then the minute the light turns green, they floor it.
Yes. I saw that.
Yes.
One went by me on Fifth Avenue. I don't get it. I get it, Austin. I get this. Help me, Lisa. Ludlow won't speak to me.
Well, there's a reason. Okay, so the Wall Street Journal spoke with their senior director of product management, and they told them about this, right? So what he said is that they're trying to make their cars confidently assertive. That's how they put it. Yes, because they used to be a little bit passive, and then when you're passive, that can, become a little disruptive, because if you have a car who's being nicey nice, then sometimes it can disrupt things. So they say they want them to be a little bit more
confidently assertive. I used to be that confidently assertive. All right.
And then, and once you get used to driving,
my mother was teaching me how to drive.
Yeah.
And I was confidently assertive and drove the VW Bug into a ditch.
Oh, gosh.
Confidently assertive.
No, but with regular drivers, like my daughter, she just started learning. She was 2 hands on the wheel. Now she's got like a Starbucks, one hand. She's I'm like, no, you can't get confident like that.
Next.
Here we go. Okay, there's a new in-demand job skill. Are you ready for it?
Yep.
It's being an influencer on social media, okay? So companies like Starbucks, Delta Airlines, they're
hiring people to be these specific positions to show how fun the company is to work for, or to give different details, all with the approval of the company, however.
Okay.
So they're saying it's a win-win for the company. So it allows the companies to showcase, hey, this is a great place to work. And then it allows the workers a chance to bring their skills to a bigger audience. They get, work trips, professional development training. They get to update their resume, their LinkedIn profile. So
I think Rich can be our social media influencer for Bloomberg.
Ken Felio, our global technical director. Can you see Ken Felio on TikTok advancing the Bloomberg surveillance message?
I don't think so.
Oh, gosh.
No, I'm not sure we have any
Lisa,
skill there.
It's a
as
big
an aside,
thing.
Lisa, you kill it every day.
It's a big thing. It's a big thing. I'm not walking around my phone, though. I'm trying to detail. We'll see if that comes to it. Okay, so there's a new exclusive club, okay? Soho House, better look out, okay? It's in New York City. It's called Moss. It recently opened. It's 5 stories at 525th Avenue, right by 43rd Street, so right in Midtown. It was founded by these 2 sisters, and the New York Post took a tour of it, right? So you have 5 fancy restaurants, all this lounge space, 20,000 square feet of dining and social space. Here's a good thing, 20,000 feet of wellness space. There's 2 floors for
So they
a gym.
have a cigar bar.
Yes, if that's your tip for wellness.
All right, Haley
Yes.
and Colleen Brooks call Moss a mix of, quote, intelligent leisure and physical culture.
That's
There you
our
have it.
audience.
There you have
That's-
it.
I
Now
can't
the
believe they're not
cost
calling
of
me
it.
here.
Cost.
Okay, the cost.
Go.
Here it is. Okay, monthly dues anywhere from $280 to $745, and that's on top of the initiation fee, which can run you from $1,500 to nearly $4,000.
Nice.
So that's just to be a member, and then to get there and to pay for all your food and drinks and all that.
Wow,
kind of
that
stuff.
sounds like it's just
But
made
it's
for
like,
Lisa Mateo. I think that's
I've
made
been
for
to
Lisa
Soho
Mateo.
House, and I'm like, maybe I
Nice.
have to find a friend who comes over to here. But it's
Very
just
nice.
another place that people can spend their money here in New York City.
All right. I mean, there's the clubs everywhere. I mean, the old clubs, vintage clubs that have been around for hundreds of years, and then some of these new clubs as well.
We're coming up, the concept next year, folks, club surveillance. It's in Lisa's living room. Lisa Mateo, thank you so much. The newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.